Hey, what's going on everyone? It's Griffin here and I hope you're all having a great day as always. Now, in today's video, I wanted to revisit some extremely important information that all investors need to be aware of when first starting out, or even if you've been investing for a while now, it's always beneficial to get a refresher on everything you need to know about the different forms of taxation on your investments. Covering new and interesting stock and ETF picks is always one of my favorite forms of content to produce, but being a well-rounded investor is more than just buying and selling a handful of stocks if you want to be able to maximize your returns and essentially keep more money in your pocket. And I will level with you here, taxation on investments is one of these topics that most individuals aren't too fond of, except maybe a handful of CPAs. But even though most retail investors don't really need to get hung up on being hyper tax efficient in their portfolios, it's still really important information that I feel the need to reconvey every once in a while on the channel, especially since the community here is growing extremely rapidly. So that's exactly what we'll be speaking about in today's video, going through a full walkthrough of everything you need to know about taxation on dividend income, capital gains, interest income, tax-free gains, foreign withholding tax, and everything in between, all of which is also going to be applicable to the RRSP, TFSA, and cash account. Now, this video is tailored a bit more towards the Canadian side of investing. However, for American viewers, a lot of this information is still relevant because the tax codes do have quite a few similarities, especially relating to the Roth IRA as well as the IRA accounts. Even still, always make sure to consult a CPA for your year-end taxes if you don't feel comfortable with that, and or for your investment taxes. But with that said, let's get right into the first topic of conversation, which is going to be capital gains. Just before that though, I do have to mention that upon a high request for some new tiers on my Patreon page, I did switch things up, so there are now 4 tiers total, one of them simply including you to the Discord server at a cheaper monthly rate, and then another one where I'm now including a link to the new public stock market portfolio that I've built specifically for the Discord group. In addition to this, everyone who's a patron, regardless of the tier, will have their name featured at the end of every one of my YouTube videos, just as a public thank you for everyone who supports the channel. Alright, so with that said though, the first form of taxation that we'll be covering here is called the capital gain. And this may actually be a term that you're familiar with if, for example, you've been a homeowner in the past and you've sold your home at a profit or any other property, or even if you've held some stock in your portfolio once and sold it at a profit. At its most basic form, a capital gain is pretty much just that. It's a gain in capital on an investment that you've held for a certain period of time. Now, the reason why there's actually a specific term used for the capital gain is because in the Canadian and American tax codes, capital gains are going to be taxed favorably and differently than other forms of income, like for example, employment income. In fact, as a little side note here, employment income that you're generating at the personal level is actually one of the most heavily taxed forms of income out there that you can generate with little to no tax sheltering benefits whatsoever. So that's why you might hear sometimes the idea that the middle class end up paying a high percentage of taxes collected in Canada, for example. Well, that's because the middle class typically has either 1 or 2 sources of income, most of them being employment income, which are taxed extremely heavily, and there are little to no tax deductions possible on employment income. And this is also the reason why wealthier individuals typically will pay less tax on a relative basis in contrast to, say, someone that's in the middle class, because a larger portion of their income is either investment income and or income generating, or should I say flowing through a corporation, all of which carry less tax burden. So back to the capital gain though, this is income that you're generating from the sale of one of your investments, and that can be, for example, stocks, ETFs, property, or pretty much any other form of investment that you've held, and in that period of time, it is appreciated in value up until the point that you sold it. And capital gains are highly advantageous from a taxation standpoint over, say, business or employment income, because only 50% of that capital gain is going to be added to your taxable income, which will have an impact on your marginal tax rate. Also note that capital gains in an investment portfolio only apply to a cash or a margin account. If you're investing within a TFSA or an RRSP, both of which we'll be speaking about shortly in this video, capital gains are not going to apply. As an example though of a capital gain, let's say you generated a total capital gain of $2,500 and this was done outside of a registered account, meaning not in a TFSA or an RRSP. And let's say for the sake of this example, making it simpler, you were in the highest income bracket in Canada, and let's just say it was 50% flat in marginal tax rate. Well, in this case, if you generated a capital gain of $2,500, only 50% of that amount will be added to your total taxable income, meaning $1,250 would be added to your taxable income. And then from there, if your marginal tax rate is 50%, well, 50% of the $1,250 would be paid to the CRA and or your provincial government in the form of that capital gain, which would be around $625. Now, obviously, that was just a quick and simple example with round numbers and no decimals, and it's also going to vary greatly depending on the province or territory that you actually reside in and pay taxes in. Also, the tax burden that you're going to incur on your capital gain is also going to vary greatly depending on your total taxable income, and for this reason, the marginal tax rate that you find yourself in. And by the way, if you want a fun way here to estimate the taxes you'll have to pay at the end of the year, including capital gains, I know that that's never fun, but if you want an intuitive little platform to use here where you can check your estimate for how much you're gonna have to pay, make sure to check out Wealthsimple Tax's income tax calculator. It's free to use, and so is the entire Wealthsimple tax platform if you even do want to use it to file your taxes. I personally used it for many years, and honestly, it's pretty great. To wrap up this section on capital gains, all you really need to remember is that if you're selling one of your assets at a profit, either stocks, ETFs, real estate, etc., well, if this is sold at a profit, you're going to incur a capital gain, and capital gains are taxed favorably, all of which you do need to report though at the end of the year on your tax return. Another little side note here about real estate, and I know I'm doing a lot of side notes in today's video, but if you sell your principal residence and you have lived in it for more than 1 year, even the capital gain that you may incur on the sale of this property is going to be completely tax-free, which is pretty awesome. And one last thing to mention here is that capital gains do not apply in tax-free income, meaning income that you're generating or a gain that you're generating within a tax-free savings account or a Roth IRA, all of which we'll be speaking about shortly in today's video. Alright, so following capital gains, we need to quickly speak about what business income is so that you have a full picture of the different ways the CRA views investment income. Now, for most investors watching this though, truthfully, you won't ever really need to worry about your investments being considered business income. And the reason for this is because most likely you'll be investing in a tax-free savings account where the gain on capital as well as dividend income and all that will be completely tax-free, or even if you are investing outside of a registered account like a cash or margin account, once you have fully maxed out your contributions for the RRSP and TFSA, well, most likely you're going to be holding your investments for a long enough period of time anyways to incur capital gains when it comes time to sell your assets, unless you are actually day trading in your cash or margin account, and that's why we need to quickly speak about business income. So business income is basically just that. It's income that you're generating from a business system with the intention of pulling a profit from it, and this can include pretty much anything you can think of, from selling shirts to selling things on Amazon, this YouTube channel even. All of this would be considered business income if it is outside of your investment income or even income you're generating at the personal level from employment income. Now, in the eyes of the CRA, any type of income you're generating outside of investment or employment income is going to have to be reported as business income on your tax return. And if this business income is generated outside of a corporation and that income isn't flowing into a corporate bank account, well, that business income is going to count as personal business income, all of which will be added to your total taxable income and could very well have an impact on your personal marginal tax rate. And again, even though this will most likely not impact a high percentage of the people watching this right now, well, if you're looking to heavily day trade, meaning you're looking to day trade on a regular basis in order to pull a profit and essentially make this somewhat of a side hustle or a business, well, in the eyes of the CRA, this is not going to count as longer term investing in which you would incur capital gains when you go to sell your investments, right? If you're buying and selling stocks every day or every couple of days quite heavily in your cash account, well, this is very much going to be a business, and you just have to basically understand that as a side hustle of day trading or whatnot, this is actually going to be business income in the eyes of the CRA instead of capital gains. And again, I have made a couple videos on the channel previously digging further into the criteria that the CRA considers to be day trading. And I will admit it is somewhat of a gray area, and some of you may disagree with what I'm saying here, but honestly, I'm just conveying this information and you can do whatever you want with it. Also, I would highly recommend that you do consult a CPA, because at the end of the day, if you are day trading and you're questioning yourself as to whether or not this would be considered business income, well, most likely it will be, because at the end of the day, you kind of know whether or not you're day trading or short-term swing trading. And honestly here, if you're holding positions for a week or two at a time and you're not day trading on a heavy irregular basis, then most likely you have nothing to worry about. I really just wanted to mention this because as a full tax video here, I wanted to mention the difference between capital gains and business income for heavy day traders. But since we're already on the topic, let's briefly speak about how a business income is reported on your tax return. So essentially, if it's personal business income, it's just going to be added fully to your total taxable income. And so let's say you were able to generate $50,000 from a side hustle or from day trading throughout the year after all expenses have been paid. Well, $50,000 is going to be added to your total taxable income, and that can include other forms of income like, for example, your job. Now, one advantage though of business income over, say, employment income is that from business income, you can actually deduct certain expenses that helped you generate that business income. And I'm not really going to get into that for today's video, but you can deduct expenses that were incurred by the business, like for example, an office space, hardware, utilities, etc., all of which will essentially lower your total taxable business income. So all this to say that I wanted to first cover the main differences between business income versus capital gains, and they are completely different, but in regards to investing, if you are day trading, this can be considered business income. That's why it needed to be mentioned in today's video. But let's now speak about one of the main forms of portfolio income, which is dividends. So dividends are actually another form of income that are taxed favorably, and you're most likely seeing a pattern here that, hey, investment income is going to be taxed favorably, and that's the reason why when you have a substantial investment portfolio, you're going to be taxed favorably on the income generating from the investments, as well as the gains on the sale of those investments later on, all of which are going to allow you to get ahead. But yeah, so dividends are taxed favorably, and individuals who hold Canadian listed stocks that distribute dividends will get a tax break with what's known as the Canadian dividend tax credit, as opposed to, say, interest income, which is also taxed but will not benefit from a tax credit, thus reducing your tax liability. So essentially what this means here is that as a result of the dividend tax credit, well, the same amount of dividend income is going to end up keeping more money in your pocket over, say, that same amount of interest income that you're generating, because interest income is fully added to your total taxable income. It's an incentive sort of like capital gains in order to favor investment and portfolio income. And the Canadian dividend tax credit is actually split further into two main categories. The first one being a federal dividend tax credit, and the second one being provincial, obviously. So this is going to vary once again depending on the province or territory that you actually pay your taxes in. Now, a really simple and easy way, once again, that you can actually estimate how much tax you'll likely pay on your dividend income is with Wealthsimple's tax calculator. But keep in mind that an individual who's in the highest tax bracket in Canada would pay right around 29% tax on their eligible dividends. So let's say they generated $1,000 in dividend income for the year. Well, they would essentially be paying around $290 in dividend taxes for that given year. Obviously, paying taxes on dividend income is not fun at all, but at least this is taxed favorably as opposed to, say, personal income, where that same $1,000 would be about $500 worth of taxes instead of $290. And this actually bridges me over to the next form of investment income, which is interest income, which can apply to interest from high interest savings accounts, GICs, or even bonds. Now, interest income is one of the most hands-off and passive ways of generating income in a portfolio. You literally just lock up some cash in a GIC or place it in a high interest savings account, and you'll make some interest on your capital. With that said though, interest rates for these forms of investments or accounts are at all-time lows right now as a result of the pandemic and the federal government's drastically lowering interest rates in order to attempt boosting borrowing and to stimulate the economy. And what's more is that unlike with capital gains or dividend income, well, interest income is going to be fully taxed at your marginal tax rate and will not have any tax sheltering benefits. With that said, there isn't really all that much to say about interest income. It's taxed pretty much the exact same as personal income would be. But this does lead us into my favorite type of income, which is tax-free income, because who doesn't like tax-free gains? And in regards to tax-free income, what I'm referring to here is going to actually be capital gains, dividend income, and even interest income. However, instead of being generated outside of a registered account, this is going to be inside of a TFSA if you're Canadian or a Roth IRA if you're American. The beauty here is that when you invest in a tax-free savings account, you don't need to worry about ever paying tax on any of the gains or the dividend income that you're generating over the years, because all of this is going to be tax-free. That's basically the whole goal of the tax-free savings account. One of the only times that you will be paying tax in a TFSA is in regards to foreign withholding taxes, which we will be speaking about shortly in this video. But even still, you don't actually ever have to worry about paying the tax yourself, because this is withheld automatically. And from a tax efficiency standpoint, starting to invest in a TFSA in Canada or Roth IRA in the US is very much going to be the most beneficial way to start investing and grow your wealth and portfolio value over time, up until you actually max out your contribution room for either of these accounts, and then also max out your RRSP contribution room, which will have tax efficiency more in the short term. And then following that, moving on to a cash account once you've completely maxed out your registered accounts is going to be the way to go, and when you're going to actually have to think about everything that we just spoke about in today's video. Now, if you do want more detailed and relevant information about each one of these accounts, including the TFSA, RRSP, or cash accounts, then I would highly recommend that you check out one of the videos that I'm overlaying right here. They go into detail about each one of these accounts, what's beneficial for each one, and so forth. And I'd also recommend that you watch several videos in my Investing for Beginners playlist. And finally, let's now speak about foreign withholding taxes. Even though I have spoken about this previously on the channel, I still get many viewers asking me to share my thoughts on foreign withholding taxes and really what they entail. So when you invest in stocks or ETFs as a Canadian investor that are located in the United States or that hold stocks located in the United States, well, you are potentially subject to what is known as foreign withholding taxes, because the IRS wants their cut of dividend income before it actually has the chance to hit your account. And as the individual investor, you never actually have to worry about paying these foreign withholding taxes on the dividend income only, because the IRS automatically withholds them. However, there are certain ways that you can try and avoid paying these taxes altogether. First of all, in regards to the TFSA though, if you are investing in foreign companies, most specifically American companies that are held in your TFSA, there are a couple things to keep in mind here. So first of all, foreign withholding taxes will apply to the TFSA, even though a TFSA is tax-free. This is pretty much one of the only times that you will be subject to taxation on any of the income or gains within this account type. To simplify the concept though, just remember that any dividends that you're incurring within your TFSA from Canadian companies will be completely tax-free when you actually generate them, and even later on when you withdraw any of those funds from the account. Where it gets a little bit more sticky though is with non-Canadian dividends, so American issued dividends, which are going to be subject to a 15% withholding tax if earned in the TFSA. And just so that you don't get confused here, this 15% withholding tax applies to US stocks as well as Canadian mutual funds or Canadian ETFs that hold US stocks. And so the withholding tax is collected before the dividends are paid out though to the non-residents, aka us, the Canadians. So you don't need to worry about paying these yourself. Once again, it is all done automatically. And also really important to keep in mind here is that this foreign withholding tax only applies to the dividends incurred from American listed companies. So even if you hold, let's say, Apple, which is an American company, in your TFSA, and the value of shares triple over the time that you actually hold the stock before selling, even this capital gain though will not be subject to any form of taxation in your TFSA. Now, somewhat surprisingly though, in the RRSP, you will not incur any foreign withholding taxes on American dividends in the short term. With that said though, everything that you generate in your RRSP in terms of dividend income, interest, or capital gains over time, in terms of appreciation, well, when you go to withdraw those funds, all of that capital is then added to your total taxable income in that given year when you're over 60. In the big picture though, even though I am mentioning foreign withholding taxes and many individuals still ask me on a regular basis to comment about this, what I typically tell people is that you really just shouldn't get hung up on this 15% withholding tax. First of all, it only applies to dividend income. So in the big picture, it's really not that significant. And then also, if this is what's keeping you from investing in American companies, that is a huge mistake because the American market tends to appreciate significantly more, even a couple points more per year than even the Canadian market. So this can make a huge difference over the long term that you're holding American positions in your investment portfolios. So that pretty much wraps up today's video, going over the main elements to be aware of as an investor regarding taxation on your investments. I really hope it was of value to you. If it was, make sure to smash the like button. It really helps the channel out. And also make sure, if you want more information about everything there is to know about stock market investing, when you're a newer investor or intermediate investor, make sure to check out the link down below to my full stock market investing course. There's over 60 video lectures and hours upon hours of relevant content, which will allow you to navigate the market comfortably and create a portfolio suitable for your needs. And if you want to stay up to date with relevant investing content, make sure to subscribe to the channel and hit the bell button to be notified of new and upcoming investing content that I release on the channel. So with that said, thanks a lot for watching today's video, and I'll see you in the next one.